Good afternoon, Mr. and Mrs. Hess. Thank you both very much for taking the time out of your day to come meet with me today. I hope you both had a wonderful vacation in Europe. I've always wanted to travel there, experience the food, the sights, so I can't wait to hear all about the favorite places that you were able to go to. John, congratulations on your well-deserved retirement and the sale of your manufacturing business. And also congratulations to you, Mary. It's my understanding you retired last year as a high school teacher, so hats off to you for being an educator. I'm going to now give each of you a copy of your financial plan, and I want to thank you both for your hard work in collecting all of the financial data for me. I know it isn't easy, but it does help me analyze your current financial state, make the proper recommendations, and based on your financial goals going forward. From our initial meeting together, we discussed your goals in depth, and the following financial goals were identified and prioritized as follows. Number 1, reduce any estate and gift tax liability and ensure all estate planning documents are in order. Number 2, review the insurance contracts and discuss the implications of purchasing a long-term care policy. Number 3, reducing the personal income taxes. And number 4, based on your moderately high risk tolerance, a recommended diversified portfolio that meets your investment needs and expectations. In addition to these goals, there were a few additional items that you wanted to also check off your list. These were items such as what the tax implications are of selling an appreciated collectible stamp in about 10 years, which, John, I can't wait to hear about this stamp that you have. Very interesting. Number 2 is how the additional income from the installment sale agreement will be taxed to you. And lastly, you also wanted to know how you could grow your retirement assets in a tax-free manner because you were desiring to distribute the maximum amount possible to your 2 children when you are to pass. So before we dive into the financial plan that you both now have in front of you and how that is going to fit your financial goals, I wanted to be sure that you're clear on some of the assumptions that we are using to calculate certain ratios and future values here of your portfolio. So we're currently using 1% as the risk-free rate, which can be equated to what you can expect out of a risk-free investment. So think of maybe a treasury bill as a good comparison or a good fit here. We're also using 7% for the market risk premium, which is the difference between the expected return on a market portfolio and the risk-free rate. We're using 11% as the market standard deviation rate, which measures market volatility or how widely prices are dispersed from an average price. And lastly, we're assuming 2.25% as the current inflation rate, which the inflation rate refers to an overall price or increase of price of goods and can affect your purchasing power in the long run or going forward. We are keeping in mind that interest rates and inflation rates are looking to probably increase both in the short and long-term forecasts. So now that we've gone over some of the assumptions that we've used, let's go ahead and dive into your current financial state. 1, I want to congratulate both of you. Hats off for being excellent savers. So congratulations. Your current financial situation reports a net worth of $14,664,681 and a net disposable income of $1,284,467. Together, you have a sizable net worth, very healthy, and a strong disposable income that can be used in reaching your financial goals. In addition, we calculated financial ratios that measure your financial status compared to benchmarks. We discovered that you have a very high current ratio of 40.15. This is calculated using your current assets of $850,000 divided by your current liabilities of $21,169. It's It's comparing those assets to liabilities, and you're able to pay it over 40 times over. So your current savings and emergency fund is significantly higher than the 3 to 6 month amount that is typically needed, even when considering the $40,000 that you need for the purchase of a new car. I applaud you for your savings. However, we should maybe look to implementing some of this money into the market where it can match your higher risk tolerance and allow growth above the CD rates, which are in this interest rate environment are extremely low at the moment. To improve your current financial position and accomplish your goal of having a diversified portfolio that meets your investment needs and expectations, I suggest taking a portion of your CDs and investing it into your jointly owned mutual fund portfolio. Upon maturity, so no penalties and fees are assessed, of course. I also suggest immediately paying off the credit card debt that you accumulated while you were on vacation in Europe. I just don't want interest to accrue on a credit card, so I want to get that immediately paid off. Looking at your cash flow statement, which can be found in your financial plan, John, you have a salary of $11,000. Each of you are collecting your Social Security benefits. And John, you have a large installment receivable this year, which is due to the 25% down payment that was received, or $1 million, combined with the monthly installments that you are going to be receiving over the course of the next 8 years. So total income for this year was $1,651,888. When we look at all of your cash outflows or all of your expenses, your total expenses added up to about $367,421. So this gives you the net disposable income, or the amount exceeding your expenses, of $1,284,467. Now keep in mind, this year, because of that down payment that you received, you have $1,365,673 of income from the sale of your business alone. It's important to note that going forward, this amount will be $438,804 per year over the next 7 years with those normal monthly installments. Now I want to talk to you about your insurance coverage. This can be found in your financial plan under the Summary for Risk Management section. So as requested, as one of your goals, we reviewed all of your existing policies to ensure you are properly insured and well protected. First, the primary homeowner's policy is insufficient. A homeowner's policy needs to be at least 80% of the fair market value of your home, which in your case is $775,000. So that means your homeowner's policy should be at a minimum $620,000. Your current policy provides only $400,000 of coverage and could represent a shortfall should you ever need to make a claim. So I suggest immediately increasing your coverage to have at least $620,000 of coverage for your primary residence. Secondly, your vacation home homeowner's policy is providing you with $460,000 of coverage, which is sufficient enough to cover any claims on the vacation home because it has a current fair market value of $550,000. One word of caution here is let's just keep an eye on the real estate market because if the value of your vacation home does increase over the next few years, we're going to have to take a look at increasing the coverage on that policy as well so you can be fully protected. Your auto coverage looks sufficient, and the personal life insurance that each of you own will provide you both with tax-free liquidity to be used for burial and administrative expenses should you pass. As for your health insurance, you should also consider having Medicare Part A to cover any inpatient care in a hospital should that need arise. Oftentimes, premiums would be zero. In order to achieve your goal of having long-term care insurance, I also suggest you purchase a comprehensive policy that allows each spouse to share the other spouse's policy benefits. The benefits would be paid for 3 years or up to $360,000, whichever may come first. The annual premiums for such policy would be $5,250 for John and $4,000 for Mary. This should be paid out of the income received from the installment sales going forward, but these expenses are also allowed as itemized deductions, which in result reduces your tax liability, which is also a big goal of yours. So let's now take a look at your investment portfolio, which can also be found in your plan under the Summary of Investment Planning. After our last meeting, we had determined that you both have a moderately high tolerance of risk, and you're looking for a diversified portfolio that fits into this goal. I also know that it is of the utmost importance that we do not recommend any tobacco stocks due to the loss of your parents due to lung cancer. I am so very sorry to hear of their passing, and my condolences to both of you. I can assure you that we will follow this request when recommending a portfolio to you. You currently have $3,847,682 in non-qualified or non-retirement assets. And you also have $1,599,540 in qualified or retirement assets. Of the $3.8 million in change in the non-qualified assets, $940,000 of this is in an all-stock portfolio, and $2,907,682 is in a diversified mutual fund portfolio. The $940,000 stock portfolio is currently holding only 4 stocks, and it does lack diversification. It's also underperforming the market on a total risk basis when we measure it by the Sharpe ratio. However, the mutual fund portfolio appears to be very well diversified and in line with your risk tolerance. So I have no suggestions for the mutual fund portfolio, and I would encourage future dollars to be saved here. To improve the investment position and accomplish your goal of having a diversified portfolio that meets your investment needs and expectations, I suggest you implement the following recommendations. First, diversify the stock portfolio, as it only has 4 stocks with a total cost basis of $960,000 and a fair market value of $940,000. One stock in particular, stock A, has a current unrealized loss of $218,000. So we can harvest this loss and use it to offset and reduce your tax liability, achieving your goal of reducing personal income taxes. Second, because you are in a high income tax bracket, we suggest you use some tax-free municipal bonds within the portfolio to also help reduce the tax burden and make the portfolio more tax efficient. Finally, we suggest a dollar cost averaging method to be used with the down payment from your installment sale into the mutual fund portfolio using a monthly schedule. You can also invest the matured CDs in the same manner once they actually mature. If you accept these investment planning recommendations, we will develop an asset allocation strategy for your portfolio that maximizes return in a tax-efficient manner, is more diversified, and matches your moderately high risk tolerance level. And we can review that in another meeting. Now let's take a look at your retirement accounts. Now that each of you is fully retired, contributing to your 401k and your 403b plans is no longer an available option. You can, however, implement some additional savings by contributing to a non-deductible IRA and filing a Form 8606 each year, with having the flexibility and option of converting this money at a later date to a Roth IRA. Now, in the Roth IRA, money can grow tax-free. And that was fitting your goal of wanting to grow retirement assets in a tax-free manner so you can leave that to your kids to inherit. I also want to discuss some of your goals in reducing your personal income taxes. So after the sale of your business this year, you are faced with receiving a $1 million down payment from the installment sale, plus monthly installment payments of $36,567 per month for the next 8 years. You also have a collectible stamp that was gifted to you from your mom that is appreciated in value that you might want to sell in about 10 years. With you being in the top marginal tax bracket and your goal to reduce personal income tax, here's my recommendation. Let's spread the tax liability over 8 years of the installment term. This will reduce your tax liability for this year. Also, you should transfer the stamp into a charitable remainder trust that can pay you income for life and will eventually benefit a charity. No taxes will be due when the stamp is sold, avoiding the hefty 28% collectible tax that this would normally be subject to. This would save you about $228,900 in tax. So, it avoids estate tax, as this will be going to charity after you pass, and you'll also get a charitable deduction calculated using your basis of $500,000 from when the stamp was gifted to you by your mother. You would also be able to take income on the full adjusted sales price of $1,317,500, which is less the 15% commission, and this would achieve your goal of reducing personal income tax. The last area that I want to go over with you here today is planning for your estate. I want to make sure that we plan appropriately so you can leave your family with as much money as possible should you pass. As of right now, Mary's estate is less than $11.58 million, so her estate would not be subject to an estate tax at this time. However, John's estate, currently worth $14,954,680, would be subject to an estate tax at a rate of 40% for any amount exceeding the $11.58 million. Also, important to note, the qualified retirement accounts that each of you have the estate designated as beneficiary, forcing these assets to go through probate. So I would change the title of your various properties, the vacation home, the boat, the auto, the CDs, and the mutual fund portfolio, all to joint ownership. These changes would automatically transfer the properties to the surviving spouse at the first spouse's death, which is on par with your objective. I also want you to visit with an estate planning attorney to obtain powers of attorney, healthcare proxies, and to talk about the charitable remainder trust for your stamp. This would achieve your goal of having all proper estate planning documents prepared accordingly. You should immediately update the beneficiary information on the qualified retirement accounts to be 100% spouse, and then the kids 50-50 as contingent beneficiaries from there. This ensures that the accounts get passed directly to the surviving spouse, surpassing the need to go through probate. Also, I would want you to establish TOD beneficiaries on the stock and mutual fund portfolios, and also establish POD or payable on death beneficiaries on the various bank accounts. An appointment with an estate planning attorney is needed to get these accomplished, but very important to your estate planning goals and objectives. And if you don't have an estate planning attorney in mind, I can refer you to one in our area, and I do want you to make this meeting as soon as possible. So today we did cover all the topics surrounding your financial plan, including your current financial health with the balance sheet and cash flow statement. We reviewed your insurance coverage, the diversification of your investment portfolio, as well as your retirement accounts, and an option of how to start growing a retirement account in a tax-free manner. We covered tax planning and reducing your personal income taxes, and how to better prepare your estate to plan for the unexpected loss of one or both of your lives. To look back at your goals and the action items that are needed based on our plan, let's review each one. Number 1, reduce any estate and gift tax liability and ensure all estate planning documents are in order. So for this, I need you to visit with an estate planning attorney as soon as possible, preferably over the next week, to obtain proper estate planning documents and possibly trusts to plan for either spouse's incapacity. We need you to change the title of the various properties and accounts to joint ownership. These changes will automatically transfer the property to the surviving spouse, which is on par with the objective. And I need you to immediately change or update the beneficiary information on the qualified retirement accounts to be 100% spouse and then the kids as contingent beneficiaries or trusts, depending on the estate attorney's advice. This is all in order to achieve your number 1 goal of reducing any estate and gift tax liability and ensuring that all estate planning documents are in order. Let me know if I can be helpful in setting up an appointment with an attorney for later this week. Number 2, review insurance contracts and discuss the implications of purchasing a long-term care policy. I want you to immediately increase your homeowner's policy on your primary residence to at least $620,000 to ensure full coverage if something were to happen to your primary residence. In order to achieve your goal of having long-term care insurance, you will also need to apply for a new long-term care policy with a 3-year or $360,000 benefit that will allow each spouse to share in those benefits. Please call your insurance agent this week. Your insurance agent this week to begin the process of obtaining coverage for yourselves. Number 3, reduce personal income taxes. In order to reduce your personal income taxes, let's spread the tax of the sale of a business over the 8 years of the installment payments. Also, open a charitable remainder trust to put your collectible stamp in and save you $228,900 on capital gain taxes. This isn't as high of a priority as you don't intend to sell the stamp for 10 years, but let's get this done within the next few months. Let's also look to include municipal bonds in the portfolio to keep things tax efficient. Number 4, based on your moderately high risk tolerance level, a recommended diversified portfolio that meets your investment needs and expectations. So in order to achieve your goal of having a diversified portfolio that meets your investment needs and your expectations, you need to diversify your stock portfolio while also taking advantage of tax loss harvesting at the same time. I suggest dollar cost averaging the proceeds from the down payment and the monthly installments, as well as any matured CDs. Our firm can develop an investment asset allocation strategy for you that maximizes investment returns, minimizes taxes, excludes tobacco companies, and is aligned with your tolerance for investment risk. We will present our investment planning recommendations for you at our next meeting. Let's plan to meet again in 2 weeks. I know we covered a lot today, but I will be your trusted advisor throughout your entire retirement. So Please don't hesitate to reach out if I could be helpful with any of your questions. Please also reach out if you have any material changes to your financial situation. It is important that we review your financial status on a regular basis so we can make updates to our plan accordingly. I would like to meet with you at least every 6 months to review and make sure that we are on track to achieve all of your financial goals. John and Mary, it was great to see both of you today. Thank you again for taking the time to come in. I hope you found this helpful and comforting to know that someone is in your corner throughout your retirement. I'm looking forward to meeting with both of you again soon. And have a great day, John and Mary. Take care.